Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
Good evening, everyone. I am Michael Hartzman. Today is Tuesday, March 16th, and Dominick and I are coming to you live from Long Island this evening. Dominick, it's good to see you. How are you?
Good evening. Good evening, all. Good evening, Mike. How you doing?
Everything is good. Thank God, no complaints. And I guess the best thing we could say about the past 5 days in the market has been relatively quiet.
Relatively quiet. Yeah, we've gone through in a very short period of time, a very large roller coaster ride. But we're kind of, if you fell asleep 2 weeks ago, was it right, Mike? You wouldn't even know anything happened. But we've been through a little bit of a roller coaster ride. I'm looking forward to going through that with our guest this evening. But the news of the day has to be the passing of the stimulus package coming out of Washington, $1.9 trillion, and the economic effects. So I think the market's been reacting to that and what the likelihood is going forward of higher interest rates and inflation. So I think we have a lot to talk about tonight.
Yeah, there's certainly a lot to cover. And I guess we would be remiss also, Dominick, if we didn't at least mention that we're also at the 1 year anniversary, if anniversary is the right word, for the pandemic sending us all into complete lockdown.
Complete lockdown and the markets to a complete drawdown. At the worst moments, the major indices were down 35, 40%, individual stocks down 70, 80%. And we've seen a very, very healthy recovery from those levels with the S&P and the Dow, I think this past week hitting all-time highs. So staying the course, staying in the game, you've been rewarded for the fortitude and courage. But it was not an easy ride, right, Mike? Not an easy ride at all.
It wasn't an easy ride, and there are certain words and vernacular that has entered into our lexicon, which if we would have said them a year ago, no one would have known what we were talking about. And the three that come to mind is a Zoom, as we're doing right now, right? Stay-at-home stocks. No one knew there was no category of stay-at-home stocks a year ago. And of course, as I heard Jimmy Kimmel say on TV the other day, if you would have said N95 prior to a year ago, you would have thought you were playing bingo. But now N95 has taken on a whole new meaning.
It really is shocking. Obviously, we're not through it yet. We're getting really close to the end of the tunnel. And the light, thank God, is starting to shine on the availability of vaccines, the sheer number of clients that are calling us daily and telling us they got at least their first, in a lot of cases, their second vaccine, and the almost euphoria in their voice that now they're going to be able to go out and hug their grandchildren and, God forbid, actually have a more normal life. But, we also have to think about the 500,000+ people that the virus took from us in this country alone, and the number is much larger worldwide. It's been something that truly, like other past crises in this country, 9/11 comes to mind, we'll never forget this one. This is going to stay with us for a very, very long time.
Yeah, the idea of all the things I thought I would live through in my lifetime, living through a pandemic was probably number 100 out of 100. But getting back to the market and the topics of the day, there is a lot to go over. We talked this morning when we did our broker call with our advisors about sector rotation, which I'm very curious about what our guest thinks about that, and really the split between growth and value and interest rates. So there's a lot of balls to juggle right now. And our guest this evening is Lauren Goodwin, who's an economist and director of portfolio strategy for New York Life Investments. We're anxious to hear what she has to say about all these important topics that we're dealing with at the moment.
Yeah, one of the questions I find that I get all the time, we're very proactive in where we allocate and how we allocate. And clients are like, "What? How did you know?" Right? And the truth is, we listen to these experts. These are the brilliant minds. I just kind of sit back and let them do the talking and hopefully give us good guidance. But this is how we know. We listen to the smartest people in the room. And I think the two guests we have tonight are extraordinarily bright people with good common sense advice for us to try to follow.
Yeah, absolutely. And there are so many questions, both short term and long term. And we always get back to this. The media seems to hyperventilate about something, one thing at a time, right? It's a shiny light. And for the last 2 weeks, it's been interest rates, right? But as
And
we said,
inflation,
and
right?
inflation. But as we said last week, are people going to go rushing into the 10-year Treasury to get 1.62%?
The flight would be a safety flight, right? But it's the idea is of bond vigilante saying, hey, if there's going to be 3-4% inflation out there, I'm simply not going to accept a 1.6% interest rate on my bond. You're going to have to give me a higher interest rate in order to convince me to buy that bond. That puts upward pressure on interest rates, downward pressure on bonds. That's what the market is focused on right now, scared about right now. This is something we really have our eye on very, very carefully.
So to that point, we will take a quick break. We'll be right back with Lauren Goodwin, and we'll get her expert opinion on these topics and more.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report.
All right, I'm Michael Hartzman. I'm back with Dominick, Tavella, and our guest this evening, Lauren Goodwin, economist and director of portfolio strategy from New York Life. Lauren, thank you for joining us tonight.
Thank you so much for having me. It's such a pleasure.
Welcome,
I
Lauren.
appreciate that. So, Lauren, my first question for you that my clients have been asking me is, ever since we had this low spike in interest rates, there's been this dramatic disconnect between growth and value. Mm-hmm. Where normally if the market gets nervous, everything goes down. But it seems that the market really sold off on the technology side and the growth side and really fell in love with value. So what is the correlation between this disconnect and the little spike we had in the 10-year Treasury?
Sure. Well, I think the word that you used there, the market gets nervous, is exactly the right dynamic to key in on, because typically when we see a lot of market volatility, the market's nervous about something that's maybe a risk off event. There's something going particularly wrong in the economy or markets, which is why we see everything sell off a little bit. That's not the case right now. A lot is going really well for the economy. You mentioned a lot of things, the stimulus being the most recent of them, and that's resulting in economic growth expectations, inflation expectations being revised upwards. And that's good news for risk assets, because even as we have bond yields rising, if earnings are rising too, they can outpace that pressure, at least for a little while. And so what you're seeing in the growth versus value dynamic is less that investors are particularly nervous about growth for some sort of fundamental reason, and more that when you expect economic growth to improve, when you expect interest rates to rise, value stocks, especially the higher quality end of value stocks, are the type of strategies that tend to do well in that environment. They're less sensitive to interest rates. They have more to gain from earnings expectations moving forward. Growth stocks, it's not necessarily true that growth stocks are a bad investment right now. It's just that they have less upside drivers in this cyclical recovery.
Okay.
So, Lauren, we've been fortunate. We started rotating our portfolios away from the large cap growth sectors, and particularly focused on dividend paying stocks. And most recently, in the last couple of weeks, we added to the financial services sector. But I'm starting to notice where the baby seems to be getting thrown out with the bathwater, where you have really good quality, large cap growth stocks that still are going to be very profitable companies. Earnings are going to be fantastic. And their growth is still, I don't see it slowing down. So do we see some of this where maybe too much of it's going on?
Yeah, I think that what you're describing in terms of that sector rotation, for most investors, that's a tactical opportunity, something that for the next 6 to 12 months, because we're having experiencing a good economic environment, that again, those types of investments can outperform for some period of a time. When we think structurally, so think your 5 to 10 year investments, and maybe that's not every investor, but most investors are investing for some type of long-term goal, then your growth stocks, to your point, the ones that have strong profit fundamentals, good business models, and adaptable business models, taking advantage of developments like technology, digitization, those are a good long-term bet. So for many investors, might want to have a little bit of both. It's that rotation into value as you've done that makes sense.
Lauren, just switching to interest rates for a second. Jerome Powell went on the record a year ago saying, to the best visibility, he's going to keep interest rates low at least through this year. And now we have these inflation concerns. So do we have faith in Jerome Powell's ability to dance on the head of a needle and keep this longer term promise and yet keep interest rates in check? And how does he deal with this inflation anxiety that's popped up recently?
We won't have to sit in suspense for very long,
That's
right?
true.
What was once the Powell put is now the Powell pushback, and we're going to have to see him do that dance here just in a few short hours tomorrow afternoon. Look, I think at least for now, it's far too early for the Fed to be signaling that they're even thinking about raising interest rates. And I think I think that even when it comes to tapering, which we taper before we even get to interest rates, we probably have this year before we have to worry about it. But the markets are already thinking about it. So from an investment perspective, what investors really have to think about is, what does that push and pull in the short end of the curve mean for some of the cyclical strategies that you've identified? So in equities, for example, thinking about value stocks, dividend payers, those aren't necessarily as impacted by this impact. But in fixed income, when you're thinking about, can the Fed dance on the head of a needle? You have to think about short duration, some rate sensitive or dynamic rate strategies like floating rate ones. If I'm going to answer your question extremely directly, the Fed is going to really struggle with credibility, and that pushback, acknowledging that economic growth expectations are improving, while at the same time pushing back on any changes in rates, is going to be really challenging. And the market's already calling them out, expecting interest rates rise as early as next year. The fundamentals we have right now, I think the market's wrong, but the fundamentals can change.
Lauren, in a recent interview I did, I was talking about inflation as being pipeline inflation, meaning it could be product specific because the pipeline's not filled yet. It's going to take some time for the factories to get up and running. But can we really have significant inflation if the unemployment numbers are, I know they're improving, but when we think about how many people are underemployed at this point, unemployed, have completely left the job market, and their prospects for a job tomorrow are not really that great. Can we really have significant inflation if we have the labor situation that we have right now?
You can, for a very short period of time. In order to have a durable inflation scare, you really need wage inflation. And so under the conditions that you've just outlined, where the labor market is still struggling, it's tough to get more than 2 or 3 months of pipeline inflation, and the Fed's just not going to be worried about that. Might see some market jitters associated with that inflation. We're going to see here in the next couple of months. You said the word anniversary. I don't know if it's the right word either, but that's the type of I don't know what the right word is, but that's the type of year-on-year effects that we'll be seeing here, that pipeline of inflation for a little while. The interesting dynamic, or the thing I'm looking at with respect to inflation, is I actually can see a clear path to some inflationary pressures here for the next 2 or 3 years, because there's a way for that labor market issue to resolve. If you have economic reopening happening, relatively straightforward way, and you also have state and local government financing, part of the aid from the recent stimulus package, resulting in some of the hiring back of the 1.3 million people who lost jobs from that industry, you can see how, a shortage of labor, which already exists in the work from home group, could also pretty quickly creep up in some of these service related industries as well. And that'll pull more people into the labor market. And so it's not going to happen tomorrow, but I could see over 2 or 3 years having a little bit of inflationary pressure. There's a lot of ifs there, but I can see the path. The path that I'm a little bit less convinced about is the longer term inflation. I'm really in a show me the money state of mind when it comes to some of the structural factors, because when we look at demographics, when we look at some of the international factors that contribute to demand for US securities and pricing of those securities, I'm not so sure that improvements in demographics, infrastructure, et cetera, will outpace how disinflationary technology is. And so that's where I'd want to see some pretty substantial changes before I worried about inflation being more than just a 2 or 3 year thing.
Lauren, speaking of inflation, and let's just push it forward a couple of years like you just suggested, we have a really smart client base. And Dominick and I spend most of our time all day actually talking to our clients. And our clients are really looking past the pandemic. And what they're worried about now is rising taxes and the deficit, right? Because the stimulus is great and people who need this money should receive money, but eventually the bill is going to come due. So when you say you're not worried about inflation, do you tie in when does the deficit become important? When does rising taxes become important? Or do you look at them in silos?
No, I mean, as difficult as it is. Well, as difficult as it is to think about these things all at once, you really need to. I'd categorize sort of the economic nature of the question and then the market nature of the question, because from an economic perspective, if spending this money, even the direct payments, even the state and local government aid, not to say anything about infrastructure, which is, if you're an economist, tends to get bucketed in like good investment type spending, even if you're talking about just the stimulus stuff. If that gets the economy back booming a year quicker, 5 years quicker, I mean, look at the 10-year recovery we just had, the most hated recovery of all time. If that money gets economic growth higher, faster, and if we think about in terms of paying itself off, there you go. And so, if it takes, 2, 3, or 4 or 5 years, improving economic growth in that sense and a little bit higher inflation come together to make that spending not as worrisome for me. That's what government intervention is for, is to get economic growth back up to the levels where it should be, maybe even a little bit higher for a while. Now, I think the other side of the coin, though, the investment or the market side of the coin, is where taxes come in, because from an economic perspective, taxes are a mixed bag. If the reason you get taxes is because you get some of this really productive investment like infrastructure and the care economy, great, no problem. On the other side, you don't want it to be so punitive to the business environment that you actually get a slowdown. For markets, it's pretty straightforward bad news, right? It's investors don't like taxes, companies don't like taxes. But there is where you and I have to do the good work, right? The hard work, because identifying managers who can distinguish which companies are going to be most impacted by taxes, identifying the companies that might be more likely to pay a special dividend. You mentioned dividend payers earlier. In 2012, when the markets expected tax increases in the second Obama administration, a lot of special dividends paid ahead of those potential changes. Didn't end up happening, but the special dividends did. As well as helping clients to assess how a change in tax structure might change whether they want some tax advantage strategies, municipal bonds and the like. So these are, 5 and 10 year factors that from a market perspective are pretty important, but they're also areas where investors have a fair bit of control.
So we're seeing all the stimulus being sent out by Washington, but I recently saw an interview by Brian Moynihan from Bank America, and he was talking about they're looking at their own depositors, and some 60% had basically deposited that money in the bank account and not touched it, right? So I deem that to lack of confidence and maybe people not feeling good yet about going out there and spending it. But if they don't feel good about what's going on in the world, they're not going to go out and spend it. So it's sort of a defeatist approach here. How do we get people to wake up and start living again?
I don't know if it's about confidence, because consumer confidence is, for the past couple of months, been moving in a pretty impressive way. Folks,
we watch retail sales most recently be lower, right? Usually the correlation is pretty close. Better confidence and better spending.
Yeah, but $166 billion spent in December resulted in a 5.3% jump in retail sales in January. So you get 3 times that spent in March, you're going to see that jump in April and May. Now, I think the more pernicious question around spending and getting people out spending is, has stimulus, which is hypothetically meant to be spent, has it turned for a big portion of these folks putting in deposits at Bank of America and others into wealth? Because the top 20% of receivers of the stimulus checks had 2 times the liquid assets of the bottom 80%. So it's possible that we should consider some of it as unlikely to be spent. I do expect that as the economy reopens, which again, it hasn't happened yet. It's happening incrementally, but even with stimulus checks, to your point, you can't go to France right now and spend a bunch of money. Well, I guess you'd want it to be spent in the US, but you can't travel, you can't do all these things that maybe eat at a bunch of restaurants and things you'd want to do. I do expect that we will see pent-up demand spent, but I'm curious and a little bit skeptical that spending will amount to the 460 plus 160 or 410 plus 166 plus 300 in terms of the total dollars actually spent in the economy.
And Lauren, that's exactly my point I was trying to make. Thank you. The government's putting this money out there in an effort to stimulate the economy, but a large quantity of the money that has already been deposited in people's checking account is still sitting there, right? They're not spending it. So I hope as the economy, as the virus goes away and the vaccinations come back in more and more every day, every week, every month, and the springtime comes along, that this eventually changes, right? The mood changes and people will get out there. But I think it's I'm not sure it's going to work quite the way the Washington thinks it's going to work.
Well, Dominick, to your point, and Lauren, I think the way the government doled out the money was a little lazy, meaning they just gave it to everybody. So Dominick, I think the people who stuck it in their bank probably didn't need the money, right? They didn't lose their job. They're retired. So a lot of people just got money because it was easy just to give it to everybody rather than zeroing in on the people who lost their job or really were in industries that were affected by the pandemic, rather than just picking a number, 72,000, and say, okay, if you made less than that, here's money.
Yeah, I think it could be true. The question that we have to sort of mull as investors is like, what do we do about it? How do you position with that in mind? And I think that stimulus, in some cases, extremely well spent. In other cases, perhaps we'll spend the next 10 years as economists determining the answer to that question. But it's created a bridged the economic gap that COVID created in our economy. And so as investors, again, that's a risk asset story and a cyclical improvement. And, some of these longer term issues will become important. I'm not exactly sure how right now, but they'll become important for us in terms of our positioning. For now, it's the value stocks, the small caps, the financials and materials, industrials, the sectors that really benefit from the economy getting back to capacity faster than it would have otherwise. And I think that's the story for investors to take advantage of before things start to get really jumpy when the Fed comes back into play, probably next year.
So Lauren, we have about a minute to go, so no pressure. Just what is New York Life worried about right now?
Credit markets.
Okay.
In the sense that valuations, even with some of this widening in rate spreads, are really high.
Mhm.
And the only way to win in credit is to pick the right securities, to pick the securities that don't default. And so careful credit management is just more important than ever, and good managers in that way are more important than ever. And all of these, minor bumps are still considered buying opportunities where you have the right credits. But it's a pernicious, difficult world out there for bond investors, that's for sure.
And Lauren, to your point, in the last 12 months, we had a lot of companies issuing a lot of debt, right? And you wonder, will they be able to even pay it back, right? But the markets ate it all up. Markets ate up every bond that was issued, and we're stuck now with holding them or getting rid of them. And that's your job, right? You guys figuring out which one of these we should hold and which ones we should get out of.
Well, I know we're out of time, but what I'll say about the issuance is, because I think it's one of the most interesting things that'll play out in the next 12 months. A lot of that issuance they've held as cash. So now the question is, will companies pay back down their debt? Will they invest in new projects? Or will they raise equity and change their capital structure, which might be a perfectly efficient thing to do from a capital structure perspective. But for a bond investor, it's a little tricky. So you're right. Picking the right credits and deciding who will do what is going to be where bond managers add their value in the next 12 months.
Lauren, thank you. This 20 minutes went flying by, and we could keep you on for 2 more segments, but we out of time. And if you're welcome to, we would love to bring you back.
Would love to continue the conversation, and I'm glad that's your job and not ours. But thank you, and have a great evening.
Thank you both so much. Take good care.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
And welcome back, everybody, to the Lebenthal Report. I'm Jordan Kimmel, portfolio manager here at Lebenthal, and it's a sheer pleasure to bring on someone that's become a good friend of mine over the years. It's Hazel Henderson from Ethical Markets. And Hazel, thanks so much for joining us.
Pleasure, Jordan. Absolutely. I have to say I enjoyed listening to Lauren. Agreed with a lot she was saying.
Well, she's wonderful, and again, we like to really look at the markets real carefully, but to set this interview up right, maybe over 10 years ago, remember when I started building this thing called the FACTS model and most trustworthy companies, it had a lot to do with things like transparency and sustainability, and we did our homework. And we actually came across the queen of green, I'm going to call you. Hazel, in the space, there's basically nobody that doesn't know you. It's not about ESG investing. It's much deeper and longer than that. And what I'd love to do is just kind of open the floor for you to share your background, how you got interested in this, what you're doing in the solar business, and probably thinking way ahead of us kids out here. So, tell us about Ethical Markets and a little bit.
Okay, so you're going to run my little slides for me, right?
We will.
Help me out here, because this will make it go much quicker.
Terrific.
And for something completely different, you see, I'm talking about transitioning to science-based investing. And this means expanding the lens from the traditional financial models to bring in all kinds of models of the new risk out there in the planet, you know, whether it's a shortage of water or whether it's climate change. And here in Florida, for example, all of our real estate around the coast is being devalued because of the rising sea level. So we are measuring growth directly in the private investments in the green sector. And we've been doing that basically since 2007. And the cumulative amount right now globally, we have 10.387 trillion with a T as of 2020, which is the final one we're doing, because now we don't have to worry. We've got Bloomberg Green, we've got Bloomberg New Finance and all of this. And so we are looking at all the trends toward the circular green economies worldwide. And basically, we see this transition from the fossilized industrial era to the solar age as a $45 trillion opportunity. So then the next one now, Jordan.
Well, hold on. So Hazel, here's the point I want to bring out here. On Wall Street, they go quarter to quarter. They're looking at earnings. They're looking at how did I do versus estimates. What you've done your whole career is work with folks around the world thinking not about next quarter, but next generation. And as they say, 7 generations from now.
Right. And particularly now, the next decade, where we do have to shift now from fossilized sectors and digging coal and oil and gas out of the ground toward realizing that we get these free photons from the sun every day. And we're now learning that from plants, actually, how to capture all of the photons that we need. And so we don't need to have fuel costs anymore. This is totally changing the business model. And I rather like this little diagram with all these boxes. So you see that the global energy consumption is the little orange box in the front. Okay. And so we're living on an abundant planet. Next one, please. I'm going through these real quick. So this is our latest report, and you can download this at ethicalmarkets.com. And this is what we mean by transitioning to science-based investing. Looking at all the opportunities now in renewable energy, energy efficiency, you know, that circular economy, and life systems, which we include water, green construction, corporate R&D, and we exclude nuclear, coal, and these bolt-on carbon capture projects where they're trying to bolt on carbon capture onto old inefficient coal and oil plants. That's not going to work.
Right. Well, Hazel, let me tell you, years ago, maybe about 5 years ago, you had me read a long article on saline plants. And the whole idea that I'm bringing up here is that we tend to talk in the media day to day about the problems. And years ago, they were very worried about the blubber business, which is how energy was created in Boston. Somehow the blubber industry ended and the world went on.
Right. Exactly right. So let's move along to the next one. And this is really the model that we use. And this, all the statistics in the financial models, as you know, and in the GDP are the top 2 layers of the cake. And what's missing in GDP and all of the macroeconomic statistics are the non-monetized productive economy, which supports the official money-measured GDP. And there's the love economy. In most countries, about 50% of the production is unpaid. Now, this is Women's History Week, I think. And most of that love economy, raising children, managing the household, volunteering, serving on the school board, That's the love, the unpaid love economy. We have a TV program on that. And then, of course, Mother Nature's productivity is, we now realize, is absolutely fundamentally key to the whole thing. And that's really the plants and how they take up the solar photons from our mother star, the sun.
Right, and
So
that's not
that's the
counted in
model.
the GDP, is it?
Right. And I want to just comment now on what the discussion you were having with Lauren, which was very interesting, you know, about inflation and debt to GDP ratios.
Yes.
And everybody is really all worried. Are we, you know, the US is now going to 100% debt to GDP ratio. Well, we have been pointing out actually for decades that the GDP is a cash flow accounting model, and it accounts for all of the government investments in infrastructure, schools, roads, hospitals, sewage treatment plants, all of that infrastructure without which you can't do the private sector. And basically, it doesn't have an asset side of the balance sheet to point out, okay, what assets did we buy with those investments? And this is really what Lauren was talking about, and what Biden is talking about. We are buying, right now, I agree, we need to jumpstart the economy, which means you have to put, as Milton Friedman used to say, you have to give the money directly to poorer people who will immediately spend it into the economy for the purpose of aggregate demand. What we need now is to get the aggregate demand up and the purchasing power. And if you do the kind of normal thing, which was the last tax cut, it goes into savings, as was being pointed out, or else it goes to offshore tax havens. So this is why this is why I agree with Jack Lew. He was talking about this, that you've got to get it into the hands of the poorest people who will immediately spend it into the economy to get exactly what you want. You see,
right. Well, that's the multiplier, right? That's the multiplier effect.
Yes, exactly. And so the last piece of the puzzle is that if every debt to GDP ratio all over the planet, every country is looking at its debt to GDP ratio, if every one of them had an asset account, as you do in proper double entry bookkeeping, you could cut most of the debt to GDP ratios up to 50% with a couple of keystrokes.
Fantastic.
You see?
You know, it's so fantastic because, again, we talk about the debt. I hear it all the time. They don't talk about the asset side.
What did you buy with it, you know? And of course, that includes buying healthy children, buying public health so that you can get those vaccines into people's arms. Those are public goods and services which we desperately need to get out of this virus. So anyway, the next, show me the next one. So we are shifting now to this new metric, which is much broader. And this has been ratified now as beyond GDP accounting. These are the Sustainable Development Goals, which 193 countries adopted at the UN in 2015. So this is the new scorecard. And that's what I mean by steering societies from the old GDP model, very, very narrow, to this is what we have to pay attention to now, all of these 17 different goals, and they're all completely integrated. And this is a systemic model of human progress and development.
Right. So Hazel, let me just mention that there's a belief that companies and it's got to be grinded down with competition, and we got to maximize. And what you're basically saying is that more important that the world survives, that we actually slow things down, maybe a drop, and actually not burn the planet while we're earning money.
We can't burn the planet. There's no way we can do that. So
let's see what's next on your presentation. And
so put on the next one, because you see, this is what I'm talking about now. Since those actually 195 nations, when they ratified that new model of the Sustainable Development Goals in 2015, and all of these countries committed in Paris at the climate conference to what they call national development commitments, that was a new model. And the traditional legacy banking and financial markets are now kind of boxed in on all sides with this new model. On the one side, you've got the ESG kind of fossil fuel free portfolios that we cover, that are successful portfolios without, not only without fossil fuels, but green portfolios where you're getting double, sometimes triple digit returns from pure play, small companies in green technology.
Let me do this for us, Hazel. I want to advance to the last slide where your information is, and I want to bring in Dom and Mike right now, because what's really interesting, because we're going to come on and do another segment with you. I think what you're doing, Hazel, is so important.
Well, I need you to just show the one before this one you've got here.
We're going to do it.
The one on the, go back a little bit, just go back to this one. Now, you see, we've been doing surveys in 12 countries all around the world since 2009, where we ask ordinary people, is the proper way to measure the progress of our country a money-based indicator like GDP, or should we expand it to include health, social and environmental statistics? And you see, in every one of these countries, people prefer to have these broader statistics. So that's, I needed to tell you that, because we just did this new one in 2020, and we've still got 72% average. Ordinary people are way ahead of the economists, way ahead of the financial planners, and this is the real world. Well, so now you can, and I'll finish now.
That's okay. I don't want you to finish. I wanted to bring Mike and Dom on, because we're in the real world. We're also managing money, but I think that what's important is the blending of doing well, doing good, not quite ESG, but on another metric. But we're going to run out of time if I don't let Mike and Dom jump in right here. And you guys have anything for Hazel?
Hazel, thank you for joining us. I'm Michael Hartzman. Nice to meet you.
Nice to meet you, Michael.
Hazel, I guess my question is, has corporate America embraced your 17 points?
Yes.
Do you see changes being made?
Yeah, what's happening now, corporations are picking up these different 17 goals, and they're saying, okay, our business model can address goal number 3 and goal number 6. And then another company like Unilever, they're very systemic. They've addressed all 17, and they're moving to the circular economy, which is upscaling all of the waste, no more using new virgin resources, just super upscaling, upcycling every component of the former quote unquote waste stream. See, nature doesn't have a waste stream. And so it's a very interesting thing, because I'm advising a portfolio in London right now called Exponential Energy Fortunes. And they are all small cap companies like the one I'm a big winner in right now. Which
hold on a second, Hazel. What I have to do, because this is media, we can't help it. We're going to bump up against time. I promised you what we'll do in the future is dig in on more what you're doing on ethical markets, because I think it's not only important. I think who you're doing business with worldwide are leaders. And I think that you're a leader, and I appreciate you joining us. Dom had a question for you. We're going to run up against time.
I'm not even going to bother, but Hazel, I want to thank you. And I do want to confirm that both clients and companies are literally focusing on this on a daily basis.
Oh,
and that
definitely.
can only be good for all of us as a planet. So
absolutely,
it's a long time coming, and I should have started a long time ago, but it's clearly in the pipeline today. Corporate America is acknowledging this and heading in that direction.
They are, yes. It's going.
And what I'm doing, Hazel, from the the public side, doing my metrics and having the most trustworthy companies. I know you're more of a futurist, but listen, thanks so much for joining us. We're going to dig deeper with you on this in the future.
Great pleasure.
So,
Thank you,
my
Hazel.
pleasure. Been ours.
Thank
We'll
you
be
so
right
much
back
for this
with more of the Lebenthal Report following a real quick break.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
And we're back. So Dom, we always talk about how these shows are unscripted. I mean, literally, we've reached the point we wouldn't even talk about it until I see your face pop up 5 minutes before we go on the air. And we're never at a shortage of discussing things. And once again, tonight between Lauren and Hazel, there's a lot to unpack.
To tremendous women in our industry and incredibly bright people. And both our guests, we could have gone on much longer with so much insight. It really is tremendous. We're fortunate to be able to get these guests on the show.
Absolutely. And, just to touch upon what Hazel said first, I do notice that more and more companies are embracing her 17 points. As she said, not one company, most companies cannot embrace all 17, but they certainly are more mindful that we have one planet and we all have to do our part to take care of the only place we call home.
Yeah, look, Mike, I know it sounds like common sense, and it's amazing to me how often common sense seems to leak out of people's ears, especially in the corporate world. But if you're a good citizen, whether it's corporate governance, ecology, sustainability, then generally speaking, your company is viewed in a positive way, and that's very positive for your stock price and earnings and everything else that goes with it. And if you're not a good citizen, you're going to suffer the consequences. We've seen many companies where the stock price gets cut in half or worse because they've done something immoral or illegal, and as they should be, right? You should be punished for not being a good citizen.
Yeah, we all remember the BP fiasco. What was it, in the Gulf of Mexico? I think.
Mexico, yeah. They saved a few dollars by putting not doing the level of quality work they should have been doing, and the company suffered, right? And shareholders of the company suffered. So there is a direct consequence to not being a good corporate citizen.
Right, and then the flip side of it is she talks about solar and electronic vehicles. There's only a finite amount of oil in the ground. So, it's great that we're all mindful and being good citizens, but the flip side of it is we have to come up with alternatives because there's only X amount of oil that we're going to be able to use, and eventually we're going to run out of it.
Could not agree with you more. The issue that we're dealing with today, and certainly in the economy, is this transition stage where we go from one resource to another resource, right? And how fast we go, and how much pain. Some people can't afford to put solar panels on their houses, right? Or buy a electric car. So, it needs to be done. This conversion needs to happen. How quickly it happens and how quickly we as a people, as economy can get it done, that's the question right now.
Right. And then to good segue, as always, you mentioned quickly, and Lauren's last point was, people are so focused on worrying about 6 months from now, a year from now, a year and a half from now. Let's just take a deep breath and let's just realize that we just did get stimulus. We are all getting vaccinated. The country is going to reopen. And right now, the economy and the market, God willing that these variants don't take hold and we don't get shut down again. But the way things are looking now, things are okay. And sometimes it's hard to convince people of that.
Yeah, look, it's our job to look for the black clouds and the bad weather. Let us do the heavy lifting on that, right? But you're spot on, Mike. We've been telling clients for over a year, this thing does have an end in sight. It's a long way down the road, but here we are a year later, and the end is clearly right in front of us. But as Lauren brought up, it will not be a smooth ride even today. We got some news out of Europe. They're getting some bumps in the road with their vaccine. This is bound to happen, unfortunately, but it is normal. So just hold on tight. We're on the home stretch here. It might get a little bumpy again, but we're as always, we're prepared for it. We're looking at the weather report, and I think we'll get through this one okay. I honestly, God, think we will.
No, I think we will. And there's, look, there's always, as we constantly say, there's always something to worry about. But for now, I think we're in a much better place than we've been in a very, very, very long time in terms of the economy and where we're positioned at this moment.
Tomorrow we have Chairman Powell and the Fed Reserve making announcements again. So we're all going to be very focused on that and what their commentary will be on interest rates and inflation. So that could be another bumpy bump in the road. Hopefully not, but certainly the market's going to be extraordinarily sensitive to that. So we'll keep our eyes on that one tomorrow.
Yeah, like you said earlier, we worry about coming up with a topic once a week and something to talk about. And then, there are two 24-hour news channels that just talks about the market and Wall Street. So whatever Chairman Powell says, I'm sure, the news media will repackage it in a way for us to have something else to worry about and something else to talk about.
Markets will react maybe accordingly and we'll digest it and we'll be off to the races again. So just another bump in the road and this too shall pass. So looking forward to that.
Absolutely. So on that note, my friend, where we wrap up another show, have a great evening and I will see you in a week.
Terrific.
Sooner.
Everybody be safe.
Be safe, everyone. Have a great night.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.